I'm Tom Selzer from Livewire Markets, and joining me today is James Fleiter from Betashares to discuss the opportunities in private credit markets right now. James, thanks for joining us.
My pleasure. Thank you for having me.
James, you're a director in the new Betashares Private Assets division, Betashares Private Capital. Do you mind explaining the opportunity that Betashares has identified here and why the move into private credit now?
Absolutely. And the opportunity is somewhat twofold. And there's the opportunity for investors themselves and then Betashares. And the opportunity for investors is really they can finally access private markets. Access has come an incredibly long way in the last 10 years. 10 years ago, if you wanted to access private markets, private equity, credit, you sort of needed to have a minimum investment size of about $5 million, and you'd go into some drawdown fund and you might get your money back in about 10 years' time. Now, with the evolution of structures, you can invest in products with daily applications, quarterly redemptions. These investments are far more accessible than they've ever been before. And that's a great opportunity for investors to generate better risk-adjusted returns. And the opportunity for Betashares is really to just play the same role they've played in the public markets, which is bringing smart, diversified, cost-effective solutions to investors. So this is really just an extension of what they've been doing in the public markets, but now being able to provide the private markets exposure to our clients as well.
And this move into private credit, I think you've teamed up with Cliffwater in the US. Do you mind explaining just a little bit about that partnership?
Yeah, sure. I mean, Cliffwater, one of the most well-known names in the US. They were founded in 2004, so they've been around for about 20 years, and they're most well-known for being one of the largest asset consultants in the space. But they also are one of the biggest fund managers. That they manage about 41 billion US dollars, serving the financial advice market in the US. And we're really providing access to their suite of funds, specifically in this case their flagship corporate lending fund.
And you've launched the Betashares Private Capital Cliffwater Private Credit Fund. Do you mind explaining a little bit about the funds, especially in terms of, I think it's US exposures and how that maybe differs to Australian exposures?
Betashares Private Capital Cliffwater Private Credit Fund. So that's a daily application, quarterly redemption, quarterly distribution fund that's investing in what's called the US direct lending market. Now that's an important distinction because private credit means a lot of different things to a lot of different people, and there is huge swings in the risk profile between. So this US direct lending fund is the most diversified fund in the world, and it provides first lien loans, private equity owned businesses in the United States. Has low LVRs and typically companies that are classified as middle market, which means EBITDA between $10 to $200 million. And so we're providing a currency hedged access point to this fund, which is one of the biggest funds in the world, frankly.
There's now quite a few ways to access private credit, from listed and non-traded BDCs through to interval funds. Do you mind explaining some of the differences between those structures and what it means for investor outcomes?
It is an incredibly important topic for people to understand because the structure really informs the risk that people take and what to expect from your private credit exposure. So the listed BDCs, these are called business development companies, very much like closed-ended funds. They trade on an exchange. They're able to use $2 of debt for every dollar of equity you put in, so they're very levered exposures and they charge very high fees. They're a great exposure if you want to be able to trade daily, but with that comes the problem that they can trade away from NAV. The non-traded BDC, a similar structure, although that trades at NAV, still uses a lot of leverage though, and generally speaking, high fees. The interval fund is probably the most investor-friendly structure. This is regulated under the same Investment Company Act of 1940, the same regulation that governs US mutual funds. That caps out what you can use from a leverage standpoint at 0.5 times leverage. So it's a much lower risk solution. And then these structures also govern what sort of liquidity you can get. And that's an incredibly important topic when you're talking about private assets. So typically a non-traded BDC might be able to give you 5% liquidity subject to board approval every quarter, whereas an interval fund must provide at least 5% liquidity every quarter at predefined intervals. So there's a little nuance there, but these differences make all the difference when understanding the sorts of risks that you're taking within private credit.
And if you say the key to understanding private credit strategy is understanding the risk instead of the return, what do you think investors need to know about a strategy before they invest in something?
They need to know basically what they're investing in, and they need to understand the credit profile of the investor. Private credit just tells you that you made a loan to someone and they're going to pay you back and you're going to receive a coupon. It doesn't tell you anything about who the borrower is, what the proceeds are going to be used for, or how risky the borrower is. That's the key to understanding the risk. And the question then becomes, is the return I'm getting worth the risk that I'm taking? So some of those key questions that people should be asking is, what sort of private credit is this? US direct lending is one of the deepest markets, generally speaking, done well, very low risk. Then the question is, are we lending to private equity owned or sponsor businesses or non-sponsor? Typically non-sponsor businesses are higher risk because you don't have that ownership support when times get tough, like COVID happens. Or the LVR, loan to value ratio, lower is better. This just talks about how indebted a company might be. And then asset seniority, when you have security over an asset, a lot of people talk about being senior. Cliffwater, for example, are first lien, which means they're at the very top of that capital structure, which again means low risk. These are the things that people need to understand when they look at any private credit strategy, because that just helps you understand the sort of risk that you're taking. And only then can you understand if that return is worth the risk.
And finally, I think we've seen a rise in intermediaries and investors increasing their allocations to private assets, including private capital. What do you think's behind that shift, and what role do you think it can play in an investor's portfolio? Everyone's
essentially seeking higher risk-adjusted returns and enhanced portfolio outcomes. Doesn't matter if you're looking at private equity or private credit, the asset classes typically provide higher risk-adjusted returns, but the trade-off is they're not as liquid. So you definitely can achieve a higher risk-adjusted return, but you do have to be mindful that you're giving up a bit of liquidity. And what does that mean? Well, in private assets, you can earn what's called an illiquidity premium, in that because the assets are less liquid, investors require a higher return in order to make that investment. But these assets can typically be less volatile. And also, there's a huge diversification angle there as well. A lot of people don't realise, public markets are massive and private markets are large as well. But whilst public markets are bigger by assets, I think there's $100 trillion of global equities and the same in terms of outstanding fixed income. By number of companies, private assets is actually the larger pool of capital. So one statistic I give is 87% of companies in the United States that earn more than $100 million in revenue are private companies. The biggest companies are public, but by number of companies, private markets are bigger. And so because there's such a huge pool of companies that people aren't already invested in, you can really boost diversification in your portfolio.
James, thanks for joining us.
Thank you for having me.
Thanks for watching. For more great videos, make sure to check out the Livewire YouTube channel and website.